Down, Lily. Now, reforms in China's capital markets are urgently needed, of course. We saw some big moves last year, like Lily mentioned. So where do we go from here, folks? To provide some more insights into this topic, we're joined in the studio by Dr. Alfred Shang, a partner at Bain & Company. He's also the co-head of the Greater China Financial Services practice at Bain. Also joining us tonight is Ms. Gao, a managing partner at Mandarin Capital Partners, focusing on Sino-EU investments, a PE firm. Many thanks, Alfred and Gao, for joining us on the show tonight. All right, so we heard from Lily a series of reforms in the capital markets last year, but we also heard the Shanghai Stock Exchange, sort of the composite, the benchmark, only up about 3% last year as well, one of the worst performers. Let's start by this paradox, this big contradiction that we see solid economic growth in China. We see these reforms, yet when you take a look at the Chinese equity markets, it doesn't really correlate well with economic growth and reforms, right? It's more of like a bell-shaped curve rather than economic growth, which is 45 degrees, right? So why is that? Explain to our audiences why this non-correlation exists right now.
Well, actually, if you look at developing countries, look at the economic growth and also the capital market, you could see oftentimes it diverges. It doesn't really reflect the growth. But in China, I think the situation is like this because the stock market, I mean, the basic one is the profitability of the company, which is trading on the market, and plus is the multiples. I mean, the PE ratio, as often talked among Chinese, but those PE ratio are actually influenced by your expectations, some policy reflected factors, and also the people's feeling about the risk involved. And in China, we can see that it's not very transparent. The quality of the disclosure is not so high, and also people, I mean, a lot of institutional investors doesn't have a very clear expectation on the like the China overall growth. And also, if you look at the index component stocks, you will find many big SOEs which are currently in loss, like Costco. So the overall the financials and the basic for that is not so optimistic. And in addition to that, you see a lot of majority shareholders is still selling their stocks. What does it mean?
Right.
They're not confident about stock, and
Right.
it's overvalued. So you cannot be going like that.
That's very important, right? We have to bring investor confidence back. Alfred, what are your thoughts on this?
Yeah, I think it's a very interesting paradox. And to add to some of the data that you've provided, there are actually two pieces that are also very conflicting with the overall economic growth. One is that the per capita market participation, meaning market cap per capita, is actually lacking some of the other economies of similar scale. That's one. And secondly, the institutional investor participation is still very low. 80% of the market trading volume is still retail contributed. So I think that two factors are actually very important in terms of contributing to the low valuation that you mentioned, and also the low liquidity level of the market. Now, I do agree that investor confidence is the most important thing, most critical thing to really restore for the market. So that is going to be a top priority for the policymakers and also for the companies in the market. Information asymmetry is one important issue.
Yes.
Accounting standards, standardizing it is also very important. And without that, valuation will continue to be low. And blue chip companies who could have a choice of going direct to debt market or going to the bank would obviously prefer those channels as opposed to the low valued equity markets.
And also you did mention that 80% of the investors are actually retail investors. Right. They do make up like a huge chunk of the investors there. So about these retail investors, from my past interviews with them, some of them would complain that these institutional investors, they have better research tools, they have more insights. What about us? Where can we get sufficient information? So do you see there is a lack of sort of education for these retail investors, and how can we improve that to better protect their interests?
I think that's a very important question. Now, retail investors globally are at a disadvantage compared to institutional investors. The information that they get are lacking. They often come from second-hand info as opposed to sometimes the first-hand info by institutional investor. And also, if you think about the behavior of a retail investor, when they get the money, they will only buy up. They wouldn't short stocks necessarily. That's just from a psychological point of view. So the instrument that they have in terms of the trading, the behavior, and the psychology behind them, which is only going to buy up or exit, sell off when they don't think the market is performing well, that is going to put them at a disadvantage. Institutional investors in China are also slightly with their hands tied because they don't have enough instrument in the market for them to perform the strategy that they want to perform. a very important function of the secondary market is the price signal. So theoretically, the price and the valuations will reflect and differentiate good companies versus bad companies.
You know what? Hold that thought on institutional investors, because in the second part of our panel discussion, we're going to expand on institutional investors. I want to sort of bring it back on what Lily said a few moments ago, more specifically about some of the reforms that we saw last year, specifically streamlining the IPO process. So between 2009 and 2011, we saw massive IPO deals in China, both in terms of the number, in terms of the size of the deals as well. I believe it was in, June last year, where the CSRC, the regulatory body, sort of slowed down this approval process, and last October it halted it completely. In the same time, it's sort of trying to increase these more IPO rules and also trying to create a delisting mechanism in China's stock markets as well. Talk to us about, explain to our viewers why streamlining this IPO process, making it more transparent is important, why having a delisting mechanism is important, and what can we expect this year?
Well, if you really look at the numbers of the companies who got listed in past years, you will find a lot of them are not qualified or are actually, providing fake information, especially in the China export. You will see a lot of company will switch their face right after the listing. I think part of the reason is because of the over packaging of the financials by the investment bankers, because there's a huge value chain under that, private equity, investment bankers, and also the shareholders. So I think the CSRC has realized this problem, and the reform, I think, is in the right direction, because on one hand you should really to less control on the the entry barriers. You should encourage more quantities with better quality to really come into the scene, and not to put this overall burdensome procedure on them, because as far as I know, many companies, they're thinking about going abroad because they don't want to go into the gray area of getting approved. Right. So I think this is on one side. Also, this could really reduce a lot of corruptions related issue. On the other side, we should really learn from the United States. Like you need to have much stricter disclosure system, and the company should be more liable for the information they provided, which means very harsh measures on them afterwards if they don't comply. So also I think the the introduction of class actions, it's more protection measures for investors. That's very good to make the healthy movement of this.
Now I want to get us back to the bigger picture. China's urbanization is a big topic. We all know about that since last year. Now China plans to invest this 40 trillion yuan through 2030. How would that help to develop the capital market in China? I'm thinking about maybe high yield bond market as well, maybe?
Well, according to my experience, I don't think high yield bond market is really for infrastructure or urbanization. In much developed countries, usually it's used by private equity or other financial investors to try to do acquisitions, because they can using high yield bond and to buy the asset. And then, because it's a risky business, and then this could reflect, the trading asset underneath. But usually, I don't see it to be widely used in, when you are developing a city or to finance infrastructure, because that usually could provide a more stable cash flow where you could use the normal bond.
Okay, so if not high yield, Alfred, what about municipal bond market? Will that be developed more with this 40 trillion with the plan?
I think stepping back about the whole issue of urbanization, right, is to me the critical thing is to restore investor confidence, both the retail and also institution. Right now, if you look at the fixed income market, the majority of the volume are taken up by banks and other types of large SOE companies. In order to raise the money, the amount of money that you talk about, it needs to diversify the investor base to attract foreign investor and also other types of institutional investor into the market. And that requires a lot more on disclosure, a lot more on the government's signals around enforcing the disclosure. And also one thing that I would like to comment earlier is about the role of the intermediary, the iBankers, the underwriters, the auditors. Those are the guys that, again, need to be more regulated, and also the delisting that might be applied to companies will also need to be applied to the intermediaries.
All right, folks, we are going to leave it here because we're a little bit short on time on this part of the show. Some great insights. Do stay with us, folks. We're heading for a short break. More on opening up China's capital markets on the other side. Stay tuned to Biz Asia here on CCTV News. We'll be back in a jiffy.